So welcome. Today we are going to talk about the accounting for the effect of change in foreign exchange rates, which is Ind AS 21. Now, the key for us to understand is that why do we need this standard, right? Altogether, or what's the meaning of the foreign exchange rates in the context of financial reporting? So it has two, in a way, connotations, right? Where we engage on account of foreign exchange. So, for example, if you're an Indian company, right, looking to do financial statements, accounting, and all of that stuff. So we have two levels of engagement. One is at the transaction level, because we engage with companies whose currency is not Indian rupees, right? So we engage into transaction with companies whose currency, or they are incorporated in jurisdiction where their currency is US dollar or GBP, British pound, or for example euro, or Japanese yen, or could be any other currency, right? Every country, as you know, has their own currency. And I think the key is that, of course, a lot of countries in the European Union, right, they have euro as their one common currency in Europe. From that perspective, so that's one area where we need to understand that if I'm transacting in a currency which is other than my functional currency, as what is being called, which is ordinarily for an Indian company in a large number of cases will be Indian rupees as the functional currency. And we will talk about all of this in great degree of detail, that what's the meaning of functional currency, what's the meaning of reporting currency or the presentation currency, etc. So one is at the transaction level. So you're entering into a for example, let's say if I'm Indian Oil, right? I entered into or do an oil purchase agreement in US dollar, because that's the currency in which oil gets traded, for example, right? Similarly, if I'm a company which is in the metal and mining sector, I engage into transaction. My reference rate I derive from the London Metal Exchange from that perspective, LME as what we call it, and hence you derive your rate. You engage into a lot of transactions in which are denominated in foreign currency. Then the second level where we need the involvement of this standard is at the translation. So one is at the transaction level, the second is at the translation level. And the meaning of the translation is that what happens is that, let's say, many times you as a company, you have operations in multiple jurisdictions, okay? You have operations in India, in US, in UK, in any other country, right? And as I said, every country has their own currency. And if you have operations in a foreign jurisdiction, you're doing transactions in that currency jurisdiction. And then, but end of the day, financial reporting is what we have to report in one common currency, right? We have to put it all together in one common currency. Like we do all of this accounting also in one common framework, which is Ind AS is a common framework for accounting. Similarly, we have to do, in a way, reporting also in one common currency, which could be Indian rupees, which could be US dollars, which could be euro, which could be GBP. So whatever currency we decide, which is what is being called as the presentation currency, right? Or the reporting currency, the currency in which my financial performance is eventually being reported, not recorded. Your recorded currency can be different and the reporting currency can be different. Many times they are the same, the recording currency and the reporting currency, but in a lot of situations, they can be different as well. And essentially, if you are a company which are dealing in multiple currencies, so your recording currencies are different, and then reporting currency has to be one currency for the entire organization, right? And that is being done through the process of translation. Okay, so you have transactions to deal with and you have translations to deal with. That is what is the purpose for which this standard has been written. So we will try and understand all of these terms, that what is meant by the term foreign currency, functional currency, and the presentation currency. What's the meaning of the term foreign currency, functional currency, and presentation currency? How to determine functional currency, right? How to determine functional currency. Now, that's a very, very important aspect of the standard, as to how do you determine the functional currency. Then how to report foreign currency transaction, if I'm doing a foreign currency transaction, so if let's say I am an Indian company and I am doing a transaction in US dollars. So if you have an Indian company, assuming your functional currency is Indian rupee, and if you're doing a US dollar transaction, how do you report foreign currency transaction in functional currency? What are monetary and non-monetary assets, right? So if you look at what are financial and non-financial assets, they are defined in Ind AS 109 on financial instruments, okay? Whereas what are monetary and non-monetary asset, they are defined in Ind AS 21. So the all monetary assets are also financial assets in a way, okay? But some non-monetary assets, for example, shares, investment in shares, which is a non-monetary asset, but it is also a financial asset, okay? So financial assets include not all monetary assets and, so to say, equity shares in a way, whereas everything else is a non-financial or non-monetary asset. From that perspective, we will talk about that. How to translate foreign operations. So, these are at a transaction level from that perspective, okay? And then we're talking about a translation. And how should foreign exchange difference be reported in financial statement, and what disclosures are required to be given? So all of that is what it's an important standard, right? Important standard from a application perspective. We see the application of this standard in many organizations, right? Because every organization in a way deals with transaction which is in a foreign currency, or they have foreign operations. So there are multiple things, right? Whether you have transactions in foreign currency or you have foreign operations, right? If you have foreign operations, then you need to do translation. If you have transaction in foreign currency, then you have to deal with the transaction related rules, right? Which is what we've been talking here, which is what, if you have foreign operations, then we are talking here in that sense. So point I'm just trying to make is that this is the standard which is widespread application, right? From an accounting and reporting perspective, though may not be very important from a examination perspective, right? And that is what we see, at least in the trends, right? So when I look at the trend of all the papers, right, for last several attempts, so there are of course some questions, though in November 16 and 17 it was picked up like 16 marks each, right? Pretty sizable. But in last couple of attempts, it is like 4 marks and 5 marks. So it's important, right? It's important, but not like of the business combination or consolidation or revenue recognition, where you are sure that there is going to be some questions around those topics, right? So here there are the topics being considered, 4 to 5 marks. So it's important for us to be clear on the concept, as I've been saying time and again, that and again, when you think about Ind AS 21, accounting for foreign exchange rates, okay, is that we need to think it from both from a transaction perspective and from the perspective of translation, right? And translation comes when you think of a foreign operation. Transaction comes when your organization itself is engaged into transaction with the counterparty from that perspective. So we will try and understand all of that, including, as we said, how do you determine functional currency, right? And what are the criteria which are given? A lot of these criteria are similar to what you may have already picked up in AS 11. So a lot of the principles which you studied in AS 11, lot of them are similar here in Ind AS 21, with some bit of additional, differences, okay? But I think the fundamental principles are largely similar between AS 21 and Ind AS 21 from that perspective. So let's focus on the scope, recognition, measurement, all of that. Disclosures is what we will go through. So the objective of the standard is to prescribe how to include foreign currency transaction and foreign operations in the financial statements of an entity, and how to translate financial statement into a presentation currency. Okay, how to translate financial statement into a present, so that you have one common currency, right? And issue is that what are the exchange rates to be used, right? In terms of the translation process, in terms of the transaction accounting process, and then remeasurement process, right? Because at the month end, at quarter end, at reporting period end, you'll have to determine the gains and losses, right? In relation to all your foreign currency transactions. Okay, let's look at the scope of the standard. Okay, it covers foreign currency transactions, accounting for transactions and balance in foreign currency. So in a way, let's say if you're an Indian company and you have Indian rupees, right, as your functional currency, that means if you have US dollars in your bank account, right, that is a balance in a foreign currency. So let's say if you're an exporter, you may have a balance in your exchange EEFC account, right? So that where you may have some dollar balances, you may have, let's say, traveled overseas, and hence you left with some surplus cash, which is what you have. So on and so forth. So it is common to again see balances in foreign currency, or of course a lot of companies do transaction. Ordinarily when you do transaction, the remittance of the transaction do come in US dollar, but through your authorized bank, the banks give you Indian rupees, unless you have those EFC account, as I said, where you want to retain the money in dollar. Okay, for which again, designated. This is an area which is again controlled by RBI from a business perspective, right? RBI in a way looks at it very, very closely, monitoring this. And then RBI operates through their intermediaries, which is all the banks, or other authorized agents, through which you receive, or you pay, right? Anything in foreign currency. So if you need foreign currency in the country, then you need to, of course, source it from these authorized agents. And if you receive also any remittance in foreign currency, that also has to be routed through these authorized agents, in a way, from that perspective. So again, because the government controls foreign currency in a meaningful manner, and that's how you see the RBI balance, right? How much is the foreign currency reserve we have? That's an important benchmark in terms of the stability of our economic environment, right? The country economic environment is linked to the stability or the size of the foreign currency reserve, which one may have, because that gives you a cushion against any volatility in the international market. That gives you a cushion, right, in terms of your ability to source products, or services from other countries, right? So on and so forth. So the standard, in a way, coming back to the accounting standard, the standard in a way talks about the foreign currency transactions. And then the accounting for transactions and balances in foreign currencies. The exceptions to this is the derivative transactions and balances, which are covered by Ind AS 109. It talks about foreign operations, translating the results and financial position of foreign operations. And it talks about then presentation of financial statement in foreign currency. Okay, so translating an entity results and financial position into a presentation currency if the presentation currency is different than your functional currency. Okay, so that is what is broadly which is covered in the standard, except the derivatives, which are more covered, which are covered in more detail in Ind AS 109. So what does not apply to, again, as derivatives been scoped out. Similarly, the hedge accounting for foreign currency item, including the hedging of a net investment in a foreign operation. So in a way, if you've invested, let's say you have a subsidiary, you have a company which is your subsidiary in US or in Europe, that is what you in a way exclude if you are designating that investment in a hedge relationship. And we will talk about some of this in a degree of detail which is relevant for you, right, under when we cover when you go through the module on financial instrument, right. That is where the Ind AS 109 should be applied. Presentation of cash flows from transaction in a foreign currency or to translation of cash flows of foreign operations in the statement of cash flows, right? That is where the Ind AS 7 in a way provides the guidance, and Ind AS 7 also provides the guidance that if your foreign currency cash flows, how you do the translation of that, right? That's covered in Ind AS 7, and in a way it kind of just allows you to use the exchange rate. That's the guidance. And if there are long-term foreign currency item for which an entity has opted for the exemption as per Ind AS 101, there was some, in a way, uh, carve out accounting or a beneficial accounting, so to say, which is there under Ind AS 101, which was allowed in a way to smoothen the transition for a lot of Indian companies from existing Indian GAAP to Ind AS framework. And that is only applicable to the extent you have existing long-term monetary foreign currency exposure, for which somebody would have taken a decision that the mark-to-market gain or loss will not go immediately to P&L, but will get amortized or recognized over the period of the loan. So that was a transition type of adjustment. Ordinarily now, since we are more than 5 years into the whole transition from Indian GAAP to Ind AS perspective, we generally don't encounter this now from a practical experience perspective. So we don't encounter this, but yes, this continues to be an exemption. So if let's say one Indian company currently going for transition and they have this, then they have to deal with the Ind AS 101 principles and not be guided by the accounting principles which is out there under Ind AS 21. So to put things in perspective, Ind AS 21 helps you deal with for all accounting for all your transaction in foreign currencies. And if you have foreign operations, how do you bring it all together and use the presentation currency or a reporting currency, right? So how you do the translation and how you deal with the transactions, and it excludes out, scopes out, right? Is derivatives or hedging, right? Related stuff, they are in a way covered under Ind AS 109. So they're covered in great degree of detail in Ind AS 109. And they're also in a way, so as you prepare a consolidated balance sheet or a profit and loss account, right? You also have to prepare cash flows. Now the cash flow guidance, the translation guidance is given under Ind AS 7, and we will talk about and cover that as well. All right. So we'll now go through some of the important definition for you to have better understanding. So what is a foreign currency? Foreign currency is a currency other than functional currency. Very, very simply put, right? So any currency other than your functional currency in which you are dealing is a foreign currency, right? So if your functional currency is, let's say, US dollar, and if you are doing transaction in Indian rupees, then for that company, Indian rupee becomes a foreign currency. Okay. So what's a foreign currency? Currency which is other than your functional currency. Okay. Now, what is then functional currency? Functional currency is the currency of the primary economic environment in which the entity operates. Now, so we're just trying to build these pieces, right? So first you need to understand what's a foreign currency, currency which is other than your function. Now, what's a functional currency? Functional currency is the currency of the primary economic environment in which the entity operate. Okay, primary economic environment in which the entity operate, right? And then we will talk about how you determine the primary economic environment. Okay. So how do you determine the primary economic environment? But before that, what's the presentation currency? Currency is the currency in which the financial statements are presented, right? Presentation currency is the currency in which the financial statements are presented. Okay, so we have foreign currency, currency which is other than any currency other than your functional currency is a foreign currency. We have we have the functional currency. Functional currency is the currency of the primary economic environment in which the entity operates. We will talk about the definition of the primary economic environment. And then we have the presentation currency, is the currency in which the financial statements are presented. And what's the meaning of financial statement? Is your balance sheet, cash flow, profit and loss account, statement of changes in equity, your schedule and notes, and so on and so forth, which is a full stack of financial statement. All right. So now we will focus on how you determine your functional currency, or what's the meaning of the primary economic environment, right? Now, the primary economic environment has been defined in a way in two indicators, right? The primary indicators and secondary indicators, okay? Primary indicators and secondary indicators. Let me just let the full slide come through, okay? So primary indicator and secondary indicator, okay, in which the entity primarily generate and expands cash. So in which you are generating and in spending cash in a way, right? Is the currency in which you are generating cash and you are spending cash. Okay. So what does that mean? Cash inflow and cash outflow. When you are receiving, when you're generating cash, that means there's an inflow of cash. And when you're spending, there's an outflow of cash. So cash inflow and cash outflow. Currency, what are the currencies in which you are primarily generating cash inflow and cash outflow, which is what is being called cash flows. When you say cash flows mean both cash inflow and cash outflow. So what's the primary economic environment? Is the currency in which the entity is generating cash inflow and generating cash outflow. And how do you determine this? Okay, how do you determine this? What are the indicators? Okay, so there are three indicators here and there are two indicators here, okay, which is currency that, so when you look at any business, let's just look at it from first, before I get into this, you look at any business, right? What is it we are looking at from a business perspective? We are looking at sales, right? Like, what is it I'm selling, right? What's the purpose of this entity? Then I'm looking at purchases, or in, I say, the cost. What are my cost items, right? What are my sales item? What is it I'm selling? Then what are my cost items, right? And then I'm looking at financing, right? In which currency I have raised capital, right? Financing is nothing but capital, right? Right. And then I'm looking at where do I retain my cash flows, right? Once the cash has come in, right, or I've generated cash, which is how do I look at my cash receipts and expenditure, or let me put it differently. Where do I keep my so to say let's say operational cash, right? So to say investments, right? In which currency I'm making my investments, right? From that perspective, right? Or where all a large number of cash flows, okay, where large number of cash flows are then operating or designated from that perspective, right? And then what's the regulatory environment in which I'm operating? So when you look at these criteria, primary indicator and secondary indicator, that's what we are saying, right? And you have to think it up from the perspective of any company you're dealing with, or any business we are dealing with, okay? Any business we are dealing with is to say that, do I have, in which currency, I'm designating, how I'm determining my sale price, in which currency I'm determining my sale price, in which currency I'm incurring my cost, in which currency I'm kind of spending maximum amount of my cash flows, which is cash inflow and outflow, in which currency I've generated financing, right? And which currency I'm kind of incurring cost, okay? So on and so forth. So all of that. So currency that mainly influence the sale price of goods and services, currency of the country whose competitive forces and regulations mainly determine the sale price of its goods and services. Okay, currency that influences the labor, material, and other costs.